Hello trading friends, and welcome back to Forex Focus, brought to you by tastyfx. Taking a look at the carry trade here today and what currencies might be most at risk of the next unwind in light of all the price action that we've been seeing around the Japanese yen and how that's affected almost every asset class on the board now. In the last 2 weeks, everybody has become an expert on the carry trade and how certain carry trades can unwind. We'll go through a little bit of the logistics and the dynamics that set off the Japanese yen, and also take a look at, a lot of currencies that are still showing a very high amount of carry trade, and that's the overnight funding rate that affects that carry trade, and how some of these currencies and some of these forex pairs in particular could unwind even further, and what that might mean for other asset classes. A lot to cover. Let's get to it. Starting out with just what a carry trade is. Carry trades are a strategy largely in forex markets, but can also be in certain futures markets. We're going to stick in forex because that's where the story's been, and that's where it's primarily used. But it's a strategy whereby traders seek to get daily returns from investing large amounts of capital in one country's currency relative to another, where the difference is one has a very high interest rate and the other doesn't have as high of an interest rate. And you might say, well, why don't I just forego the complexity of a forex market and just buy bonds in the US if they have high interest rates, and just leave Japan out of it because they have low interest rates? It doesn't even matter. Well, when you're utilizing forex markets, you can get leverage up to 50 to 1. And so on the flip side, that's margin requirements that are as low as 2, 3, 5%, depending on the pair. And here with the dollar yen, the margin requirement is currently 5%. And so what that means is I can come to the market with a couple of bucks and get 20 times that in exposure for this pair in particular. But for euro dollar, where it's 2%, you get 50 times that in exposure, and then utilize this interest rate differential. So of course, you can go to the US Treasury market, buy bonds or Treasury notes or Treasury bills with $100, or you can get into the Forex market and take advantage of 2 to 5%, and sometimes it's higher for more volatile pairs, but relatively lower margin requirements and higher leverage, and take advantage of those higher interest rates there. And so it's going to require a couple of things. One, with higher leverage, there's going to be greater risk that the interest rate that you're getting either changes or the exchange rate that you're trading changes, and that's a big risk. But what you're essentially doing is buying X amount of US dollars and investing that exposure at, in this example, almost 5.5%, which is where U.S. interest rates have been for the last couple of years. And you're financing that exposure with a short yen position. And if the Japanese interest rate was 2% or 3% or 4%, then you would have to pay out that interest rate on the short side of the trade. But since Japanese rates have been either negative or just barely slightly positive in recent months, financing this trade is relatively cheap, right? So you're getting the leverage, you're taking advantage of the high interest rates, but when they shift, as we've seen in recent months, the price for dollar yen, which you'd be long in this example, can go down by a large degree. We'll get to that in a second, but just to further flesh out how this works, for those of you who have traded Forex markets, you've probably seen this is a little bit more of the practical side of the theoretical carry trade that we just went through and how it works. Say this dollar yen market is 147.50. So for every dollar, 147 yen. And for those of you who have been monitoring this exchange rate for years, you'll know that the dollar yen exchange rate has at certain points in recent history been under 100 yen. And so, like I say, there's risk of that price falling if you were long dollars, short yen in this example, just highlighting that there. But essentially, for one lot of this forex pair, you'd be long 100,000 US dollars and short almost 15 million yen. And on a nightly basis, given current interest rates, and this stuff changes all the time, as we're about to look at, you would be pulling in around 2.5 pips. So essentially that 147.50 that you'd be long, every day you would be making about 2.5 pips, or the equivalent of that market going from 147.50 to 147.52.5. And then 2 nights, it would be 147.55. And so theoretically, if this market doesn't move, you're just taking in, more and more carry trade profits. And all these current metrics here, almost about $20 in a given day for one lot of this dollar yen. So that's what it looks like. That's how it works. But as I pointed out, there's risk if that 147.50, maybe you're making 2.5 pips for 30 days. You've got this trade on for a full month, and it does pay you over the weekends as well. And so you've been getting 30 days worth of that 2.5 pips. So effectively, let me do my math really quick, 75 pips there. But the market over that 30 days falls 100 pips. Well, you'd be down, right? But the idea, the strategy behind it is that, one, if the carry trade is getting more and more attractive, there might be more demand for the dollar versus the yen, and that market might move up in price, actually. And two, maybe the expectation is just currency markets aren't that volatile. They won't move that much at all. Maybe it'll go from 147.50 to 148 to 147 to 149 to 146, and just kind of bounce around in the whole time you're taking that overnight funding. But another risk, and what we've seen recently, is if interest rates change. And I know that the U.S. rate at the top hasn't changed yet, but futures markets around the Fed funds rate have already priced in multiple cuts for the remainder of 2024, and that September meeting is quickly approaching. We'll see how much they do cut, but the expectation is that U.S. rates will come down off of that 5.5% high, and the Bank of Japan is actually hiking rates as global central banks outside of Japan are for the most part cutting rates. I mean, we've seen the Bank of Canada already cut. I believe the ECB has already cut. The Bank of England is looking at cuts. And so now you have not only the U.S. and other global central banks that have hiked so much in recent years and have helped people to pile into these carry trades, like the one that we just saw unwind a little bit with that dollar yen, but it could unwind even further if the U.S. brings interest rates not only down to what's expected, which is right now 3 to 4% in the next year or so, but maybe something happens and they have to bring interest rates down to 2% or even lower. Maybe something's brewing in Japan and they get interest rates north of 1 or 2%, which would be much more than currently expected. You could see even more unwinding of that. And just as a quick aside, the term unwinding just means that, the large traders, large institutions who have been taking advantage of this interest rate differential have been taking in that $20 per one lot for the last couple of years, but at, huge magnitudes. They're starting to sell out of that position as these interest rates are potentially going to contract here. And so the idea of, you've already seen an unwind of that dollar yen market. It was trading above 160 a couple of weeks ago, and now it's trading under 150. Could it move further? Of course, historically, like I say, it's traded down below 110 or even 100 in the last 10 years. But that unwinding effect is really how many of these large institutions, large traders, different funds and whatnot going to sell out of this position that they've been in for a while. I want to now steer towards what could be the next unwind, or what currencies are at risk. There's a lot of data here. If you want to look at this on your own, go to tastyfx and you can see some of our data on the website, or you can open a demo account and take a look there at no cost. And what we're looking at here is I've highlighted a number of forex pairs that have large swap bid or swap offers. And what that means is just forex pairs that will pay you a lot in overnight funding to just hold this pair, like I say, overnight. Because the ones with the biggest swap bid or swap offer, or interest rate differential, or here I put up a metric that doesn't really mean anything, but it is kind of, it shows you a little bit what the interest rate differential is for the current swap bid or swap offer market at that overnight percentage there. The bigger that swap bid or offer is, or the bigger that the interest rate differential is between two regions, the greater potential there is for an unwind. And I've highlighted a few in particular. Now, of course, there at the top you see the dollar yen, which, and this is taken on a Wednesday, so it's taking into account the full 3-day weekend, but you're getting a little over 6 pips to hold that through this Wednesday, which is in that overnight percentage about 4.3%, which is definitely high and actually comes out to be around the interest rate differential between the US and Japan right now. But it's not the highest on the board, actually. There's other currencies on here, other forex pairs that might have more potential even than the yen and the dollar for an unwind. And I'm looking at the middle of our table here at that 6.5%. You see the South African rand versus the yen. And if we're using the yen as kind of like an equalizer, the lowest interest rate of major currencies, you can see that at 6.5%, they're actually paying you more for holding long South African rand, short yen, than US dollar, short yen, as South Africa has currently a higher interest rate. Now, if the South African economy is turning over like the U.S. economy has been, and the U.S. employment data and different data points have been pointing in the negative direction for the last couple of months, then that South African rand might have even more potential for an unwind than a U.S. dollar or a euro or a pound relative to the yen. Another piece, as you go down the list, you see the 9.9%. Now that's dollar versus Turkish lira. We're throwing that one out. Turkey's got its own crazy stuff going on, not really relevant to this kind of global potential for recession that's setting off a lot of these currency unwinds. But you do see further down the list another currency relative to the Japanese yen. That's the Mexican peso at 8.3%. That's the highest that I could find outside of that Turkish lira. In terms of carry trade that you're getting right now, and thus greatest potential for an unwind. And yeah, Mexican interest rates have been up at 11% in recent trading, and they actually cut for the first time just a couple of months ago. And so the idea now becomes, is the peso the next place to go for a potential unwind? And Mexico's economy, especially in recent years, has moved very parallel to the U.S.'s. I mean, a big chunk of the Mexican economy comes from the nearshoring phenomenon from the U.S. economy over the last 5 years, really since the pandemic especially. And so if the U.S. is starting to see slower GDP growth rates, slower employment that would likely bleed over to the Mexican economy. And we've seen that already happen a little bit in recent months. And so the idea would be, okay, you've already seen a huge dollar-yen unwind, and yeah, maybe U.S. interest rates are going closer to zero, but the trip from 5.5% to 1 or 2 or even 0 is a lot shorter than the trip from north of 10% interest rates in Mexico all the way down close to 0. It'd be a matter of Mexican interest rates falling further or maybe even faster than the U.S. And we're already seeing some of this play out in the price action, just looking at dollar peso. And I'm sure you could look at this Mexican peso versus the yen, and maybe we will look at that at a further date. But what's really interesting to me and is a dynamic of this story that I have not heard really fleshed out super well, because this stuff is pretty high level stuff. On the same day that we saw that huge move and that huge sell-off in equities and you know, the day that everybody was thinking, man, a recession, a crash could be coming here, and the dollar was getting hammered against the yen, is the same day that you see the bar here of the dollar putting in recent highs against the peso and actually climbing above 20 pesos for the first time in over a year of trading. And so this isn't just a dollar yen story or a dollar story. When you're talking about carry trade unwinding, this is essentially a story of looking at all the interest rates of, you know, mid to major economies, and major economies, of course, being the U.S., the Euro area, the U.K., Japan, and a few others, and Mexico being kind of on that middle to upper tier, growing for sure in recent years. But looking at all of their interest rates and saying, okay, if we see a global recession and interest rates across the board go from, you know, Mexico at 11% and the U.S. at 5.5%, and you know, Switzerland at 2% and Japan near 0, they all come down close to 0. Which currencies are at the greatest risk of getting affected by essentially a supply and demand dynamic that's lifted them so much in recent years that could completely unwind if everyone heads towards 0? And the peso looks like one of the most vulnerable pieces around that. Of course, this is also, you know, up to what's going on in Mexico. Mexico could absolutely, for whatever reason, have a stronger GDP and stronger growth and not move interest rates as low as the U.S. and some of these other major economies. But the idea would be, you know, when you're looking at potential for other carry trade unwinds, would be, okay, if we get a global recession here or just a global slowdown and interest rates across the board are moving closer to 0%, you know, who has profited the most in terms of currency price action here from the ramp up in interest rates? And peso would definitely be one of them. We'll continue to monitor it, and we'll bring up some more. Maybe we'll take a deeper look at the South African rand, but we'll be on the peso and a couple of other pieces as we continue to watch how the carry trade unwinding is affecting forex markets and your commodity and equity markets, everything across the board. Thanks for watching, everybody.